Hello everyone, my name is 𝗲𝘃 and I'm from the iFAST research team. Actually, this year so far has been quite a good year for stocks as several major equity markets have hit record highs. Examples include your S&P 500, in Europe we have the STOXX 600, and most recently the UK's FTSE 100 also hit record highs. But I think the star of the show for this year is perhaps Japan, as the Nikkei 225 index has closed at levels not seen in over 30 years. In fact, today I want to dive deep into Japan, which is a market that we've been positive on for the last 2 years. Now, back in 2022, when Japan wasn't getting much attention from investors, we predicted that the Japanese equity market will see a turnaround. And guess what? It turns out that we were right on the money. So this screen here, it shows you some snippets of the long list of research articles and presentations that we've dedicated to Japan before its long-awaited resurgence. So as you can see, our bullish stance on Japan actually dates back to 2022. And in January last year, we upgraded the market's rating from 3.5 stars attractive to 4 stars very attractive. And this upgrade was driven by our firm belief that Japan stands out among its peers, benefiting from positive factors such as a reopening tailwind as well as robust balance sheet strength. And at that time, our analysis suggested that Japanese equities were trading at incredibly attractive valuations. Also, in July last year, we included Japan as one of the markets that make up the new Asian tigers. So for us, the new Asian tigers, it represents a group of Asian economies that show significant economic growth as well as development potential. Now, in terms of the target price, at that time, we believe that the Nikkei 225 will hit 40,000 by 2025, which means that it will surpass its peak set back in the year 1989. We highlighted how structural factors they serve as the catalyst for the Japanese equity market to reclaim its lost decades of performance, propelling share prices to new heights. So when the Nikkei 225 smashed records earlier this year, surpassing 40,000 in the month of March, we were hardly surprised. And since the beginning of our call, the index has gone up by about 30% in local currency terms. But now you might be wondering, is Japan's equity market getting a little too ahead of itself? Well, the short answer for us is no, we don't think so. What's driving Japan's surge isn't just a temporary market frenzy. We are seeing structural factors propelling Japan's growth story. And from here on, we think that the market will go from strength to strength. And we continue to recommend investors to buy into Japanese equities. Now, apart from the remarkable performance of the equity market, this year has actually truly been historic for Japan, with the central bank hiking interest rates for the very first time in 17 years, ending an era of negative interest rates. And this also, to us, signifies a shift in Japan's economic landscape away from the lost decades, and today there are ongoing signs of improvement. We note that a key reason for the interest rate hike earlier this year, it was due to persistent inflation, which came alongside strong wage growth. And this is unlike the short-lived inflationary periods in the past in Japan, where they were mainly being driven by the surges in oil and food prices, as well as the rise in consumption tax. Now today, if you look at this chart over here, Japan's core CPI has consistently remained at or above the 2% target for about 2 years now. And also going deeper into the core CPI, which excludes the more volatile fresh food and energy prices, denoted by the orange line in this chart here, it is still at a level that Japan hasn't witnessed since the 1990s. Furthermore, initial results from this year's 𝗠𝗏 wage negotiations, they have consistently exceeded expectations. In response to rising prices as well as a tight labor market in Japan, both unions and companies, they have agreed to pay hikes that represent the largest increase in over 30 years. So this kind of strong wage increases is expected to drive up private consumption, thereby supporting moderate economic growth in Japan. Also, the increase in consumer spending that is expected to allow companies to have the opportunity to raise their prices, which in turn benefits their margins and earnings. So as a result, the Bank of Japan is increasingly confident that the country is entering into a virtuous cycle of wage and price increases that is capable of achieving the 2% long-term inflation target, which is a positive for economic growth. Other than that, investment preferences in Japan are also expected to shift as sustainable inflation makes a comeback. Domestic investors, they are likely to shift towards riskier investments such as stocks in order to safeguard their asset values in an inflationary environment. And here's the good news. After years and years of disappointment, the resurgence of the Japanese stock market presents a compelling reason for domestic investors to go back into their own Japanese equities. Also, earlier this year, in order to encourage more investment activity, Japan has revamped the government-sponsored investment account, which is also known as the Nippon Individual Savings Account, or the NISA in short. So what Japan has done is that they have raised the investment limit of the NISA by about 2 to 3 times, and also the period for tax exemptions on profits made from stock transactions is extended from a maximum of 20 years to an indefinite term, meaning that there will no longer be a limit. So with these changes, we think that more inflows are likely to be channeled into markets, and this can help to support equity prices in Japan. Besides that, we think that the monetary environment, it will continue to be supportive of Japanese equities. Despite the termination of negative interest rates, the Bank of Japan has dismissed the expectations of rapid rate hikes. And also, at the same time, market has factored in about 2 rate cuts for later this year, and that will bring the policy rate to about 0.3%, up from the current 0 to 0.1%, which is still relatively low. So we think that borrowing costs, which are expected to rise at a gradual pace, is unlikely to create a major burden on households as well as corporations. And this is due to their strong balance sheets, as many of them have accumulated plenty of cash during the lost decades. So to give you some color, look at this chart here. You can see that cash makes up over 50% of household financial assets in Japan. And that is a lot higher compared to the US as well as the Eurozone. And also, we examined the Nikkei 225 index, and we found that about 30% of non-financial companies, they have net cash positions, which means that they hold more cash than debt. And that is a percentage about twice that of their counterparts in the developed markets. Also, I think that the normalization of monetary policy, it does not take away Japan's long-term growth story. The long-term growth story still remains very much intact. Corporate reforms, they are still underway, and this is driven by the Tokyo Stock Exchange call for companies to disclose plans to improve their capital efficiency. And it's exciting to see now having more companies placing greater emphasis on delivering value to shareholders through share buybacks as well as dividend increases. So just consider this based on the chart here. At the end of March this year, about 65% of companies listed on the prime section of the Tokyo Stock Exchange have already responded to calls to enhance their capital efficiency. And this represents a large jump from the 30% recorded in July last year. So essentially, the percentage of companies has more than doubled within less than a year. At the same time, share buybacks in Japan, they are reaching new highs. Recent announcements of share buybacks have come notably from different companies from different industries. So this includes Toyota, Nomura, as well as Mitsui & Co., which is one of the trading houses backed by famous investor Warren Buffett. Now, in terms of dividend hikes, the Japanese mega banks, Mitsubishi UFJ Group, Sumitomo Mitsui Financial Group, and Mizuho Financial Group, they have all pledged to progressively increase their dividends in tandem with profit growth. And moving forward, with anticipated healthy future earnings on the back of a stronger Japanese economy, we think companies will be able to sustain the rising trend of share buybacks and dividend increases. So essentially, we view corporate governance reforms as a long-term tailwind for sustainable growth rather than a fleeting short-term catalyst. And this will likely benefit investors like yourselves. Now, another reason why we are bullish on Japan is really due to the ongoing revival of its semiconductor industry amidst today's AI boom. Japan's efforts to reclaim its lost status as a semiconductor powerhouse can boost long-term economic growth, especially since its pivotal automotives and electronics industry, they rely on a stable long-term supply of chips for growth. Now, one major initiative involves Rapidus, which is the first line in the table here. So Rapidus was established by the Japanese government together with key players in the country's semiconductor industry, such as Sony, as well as 𝗪𝘃𝗲. So if you're unfamiliar, Sony, rather than just producing your household appliances, it also produces image sensors, which is a form of a semiconductor. And meanwhile, for 𝗪𝘃𝗲, it is actually a leading company in flash memory and SSD. Now, going back to Rapidus, Rapidus, in partnership with IBM Research from the US, is working towards developing 2-nanometer technology by 2027 in Hokkaido, Japan. And this will be one of the most advanced chips available on the market. That's also not all. Japan's expertise in advanced manufacturing puts it in a prime position to benefit as global chip companies, they start to diversify their supply chains amidst the escalating tensions between the US and China. So for example, Japan plans to offer TSMC more subsidies to support the construction of a second foundry in Japan that will be capable of producing chips that can be used for AI as well as autonomous driving. Similarly, global chip companies like Samsung and Micron, they are already planning large investments in the country, and they'll also be backed by subsidies from the Japanese government. And now today, I also want to dive into one of the hottest topics relating to Japan recently, which is the Japanese yen. Now, the yen has become very cheap, making traveling to Japan more enticing, and perhaps this has even prompted some of you to visit Japan recently. So the Japanese yen was supposed to strengthen back in March during the interest rate hike, but it ended up weakening instead. And recently, due to the strong US economy and persistent US inflation, expectations of Fed rate cuts have been pushed back. This caused the dollar to strengthen, putting pressure on many other currencies, including the yen, which hit its lowest point against the dollar in over 30 years. And actually, the yen's weakness isn't just limited to the dollar. It's also taken a hit against other major currencies like the euro and the Australian dollar, for instance. And the yen, in fact, reached its lowest point against the euro and the Australian dollar in over a decade. Furthermore, the yen's also at a record low against the Sing dollar. So I remember that just a few years ago, we could barely get 80 yen with 1 Sing dollar. But today, if you go down to the money changer, you can get about 110 yen with the same 1 Sing dollar. So that's how much the yen has depreciated. Now, in view of the weak yen, Japanese authorities, they have issued verbal warnings to curb further declines, citing concerns about import costs. So while a weaker yen, it can definitely help to boost Japanese exports and encourage tourism in Japan, it also comes with the downside of increasing household living expenses in Japan that would potentially offset the benefits of wage gains. And in line with our optimistic outlook on Japan's economy, we actually also hold a positive view on the Japanese yen. And in our view, there will be a combination of 3 different factors driving the yen's performance moving forward. So this includes currency intervention, higher bond yields and interest rates, as well as the gradual return of the Japanese yen as a safe haven currency. Now, Japanese authorities, firstly, they were suspected to have intervened in the currency markets towards the end of April and early May, as the dollar-yen hit as high as 160. Official intervention data will be released by the end of this month, and this will help to confirm the suspicions. But officially, the last time Japan intervened in the currency market was back in 2022. And much like their actions back in 2022, we think that the currency intervention this time round is likely to be part of a broader strategy rather than a one-off event. And we think that traders, they might start closing their short positions on the yen as the risk-reward becomes less favorable. And currently, speculative short exposure on the yen is already near record levels, making it the most shorted currency within the G10 economies. So consequently, if Japanese authorities they continue to intervene, we could witness the yen staging a rebound in the near term. And also looking beyond short-term factors, we think that fundamentally higher interest rates should eventually strengthen the Japanese yen. While the BOJ kept its benchmark policy rate unchanged during the April meeting, it continues to take on a data-dependent approach. The BOJ governor stated that the central bank will continue to raise interest rates again if the longer-term rate of inflation accelerates. And usually the central bank provides inflation projections about 2 years ahead, and recently it has issued fresh estimates projecting inflation to remain at or above the 2% target through the fiscal year 2026. And that to us actually suggests that the central bank is prepared to hike interest rates again in the future. And supported by promising trends in wages and prices, we anticipate a surge in inflation expectations, and that could drive larger price increases in Japan. And this also heightens the likelihood of the BOJ implementing interest rate hikes again later this year. And we also expect the BOJ to reduce its purchases of Japanese government bonds, or JGBs in short. And this will signal a shift towards quantitative tightening, as it allows market forces to play a greater role in shaping long-term bond yields and interest rates, and that potentially paves way for a yen appreciation. And furthermore, we also think that geopolitical uncertainty could boost the Japanese yen, especially given its reputation as a safe haven currency due to its liquidity and Japan's stable political environment. Now, recent events like the escalating tensions in the Middle East, they only serve as reminders of the global geopolitical instability. And there's also increasing conflict between nations, contributing to a climate of unpredictability. This could prompt investors to seek shelter in safe haven currencies like the Japanese yen. And since 2008, the yen has demonstrated its strength after shocks such as the GFC as well as the COVID-19 pandemic. However, we do also acknowledge that its safe haven status has faced some challenges over the last 1 to 2 years due to the BOJ's ultra-easy monetary policy as well as a trade deficit from high energy prices. But looking ahead on a more positive note, we believe that the end of the negative interest rate policy as well as a strengthening Japanese economy could gradually restore the yen's safe haven appeal. So overall, considering the different combination of factors driving the yen strength in the future, we also recommend investors to go for an unhedged exposure when investing in Japan to potentially unlock even greater gains. So all in all, Japan, it is still one of our top equity picks after the market rally. We think that its growth narrative, it is underpinned by different structural factors, offering investors a long-term investment opportunity. So the factors driving Japan include the ongoing shift towards inflation due to rising wages, corporate governance reforms that will deliver greater value to shareholders, as well as the resurgence as a semiconductor powerhouse that will boost long-term economic growth. At the same time, we expect the yen to strengthen, which will help to alleviate macro headwinds such as rising import costs, which will in turn benefit corporations and the rest of the economy. And the yen's rebound could also lead to greater foreign investor interest, propelling share prices to new records. So overall, a stronger yen is actually not too bad for Japan. And for those who have missed the initial market rally, we think now is the second chance for you to capitalize on what could be a multi-year uptrend for Japan. Our new target price for the Nikkei 225 index is 48,000. And even after the strong market rally over the last 1 to 2 years, our target price of 48,000, that actually represents an upside potential of about 25% from today's levels, which we think is rather attractive. Our recommended ETF for you to take part in Japan's multi-year uptrend is the Xtrackers Nikkei 225 UCITS ETF, which is listed on the London Stock Exchange under the ticker XDJP. So as the name suggests, this ETF aims to track the performance of the Nikkei 225 index. It comes with an expense ratio of only 9 basis points, making it one of the cheapest Japan ETFs on the market. And remember this, lower cost means that more of your investment returns stay in your pocket. And when you make more money, you could also use those gains to plan a trip to Japan. And with that, I've come to the end of my sharing on Japan. Thank you very much for your kind attention.